Good afternoon, everybody, and thank you for joining us for this webcast presentation presented by Penn State University. My name is Jonathan Moyer. I'm a partner in the Global Corporate Group of the law firm Reed Smith, and I'll be serving this afternoon as the moderator for this panel discussion. This is session number 2 on the state of venture and growth capital in the COVID-19 era. Thinking about where we sit today, 13 months after the pandemic took hold, I think for many of us from a business and investing standpoint, where we have ended up over the last 13 months is in many ways surprising, unexpected, and at the very least interesting. We certainly can't talk about the last 13 months without acknowledging how terrible the pandemic has been for those that have suffered from the disease, for those that have lost loved ones and those that have died, and for those that have had challenges both here in the United States and around the world. And we certainly acknowledge all of that complication and suffering that the pandemic has caused. But from a business and investing standpoint, I think for those on the panel and those in the audience, what our predictions may have been about where we would be a year from now, back in April 2020, sitting here in April 2021, I think most of us probably got it wrong. So today for this panel discussion, we on the panel, and hopefully the audience as well, can view this discussion as the opportunity to take stock of what has happened over the last 13 months from a business and investing standpoint, and talk about what the effects have been, as well as what the expectations are for the coming months and years, and also generally about lessons learned. So that will be the idea that guides us on this panel discussion today. I'd like to thank all of you for attending. I'd also like to thank our sponsors of the PSVIP conference. If it wasn't for the support of our sponsors, this conference wouldn't be possible. I'm proud to say that my firm, Reed Smith, is a sponsor, and we say thank you to all of our fellow sponsors for making this conference what it is. Additionally, I'd like to say a word of thanks. I'll go a little bit off script here to Kelly Shako and all of her team that have put together this conference in this difficult environment. I think we all would love to be in person, and I know we all look forward to being together in another year and a half in person. But the professionalism, the positivity, and the focus on putting together a top-notch virtual presentation certainly deserves our gratitude. So thank you to all of them. So I'm going to go ahead and turn it over to our panelists now to introduce themselves briefly. Before I turn it over to them, I would say for the topic of this panel, which is again, venture capital and growth investing in the COVID-19 era, we're really fortunate to have a wide range of expertise and experience represented on our panel here. From an early stage founder who successfully raised money during the pandemic, to early stage venture capital investors, and even later stage growth institutional investment. So we're really fortunate to have the panel that we have. So before I take any more of their thunder on their introductions by saying what I just did, I'm going to ask each of them to go ahead and come off mute and go onto your cameras. And Catherine, I'll ask you to start with your introduction, and then after that, we'll go to Hunter, Shaunak, and Steve, and then we'll get into the panel discussion. So please, Catherine, go ahead.
Thank you, Jonathan. Catherine Mott. I'm the founder of Blue Tree Allied Angels and the Blue Tree Venture Fund in Pittsburgh, Pennsylvania. And we've been around since 2003. We operate mostly as a micro VC, and we focus on investing within about a 250-mile range. We syndicate with other of our colleagues and other venture investors from Chicago all the way down to North Carolina.
Great. Hunter Swisher, CEO and founder of Phosphollutions. I'm a 2016 graduate from Penn State. I got my degree in plant sciences. While I was an undergrad, I had the opportunity to exclusively license some technology out of the IP office and take our product called Rhizosorb to market. Just recently closed our Series A, a little over $10 million, and happy to be here today.
Terrific. Hello, everybody. My name is Shaunak Parikh. I'm a partner at EW Healthcare. First off, thanks to the Penn State team and the entire conference team, as Jonathan started off by saying, for organizing this and having me here. It's great to be speaking with you all today. Very briefly, I've been in the health and sciences space for a little over a decade now. My original background is in microbiology and immunology. Got my professional career started on the investment banking side at Citigroup in their M&A team, where I worked predominantly on healthcare. After that, I moved over to the principal investing side and eventually joined EW Healthcare, which is a firm I'm at today in New York, and I've been with the team there for about 8 years. Very briefly, EW is a firm that's been around for about 35 years. We focus exclusively on healthcare, cast a pretty broad net across the industry, invest in pharmaceuticals, devices, tech-enabled services, and diagnostics. And today we are a growth stage investor. So we're really helping companies that are commercial stage accelerate their top line growth. And we're investing out of our 10th vehicle, which is a $750 million fund. Thanks for having me.
Hello, everyone. I'm Steve Carpenter. Since completing my MBA at Penn State in 2004, I've worked for the Life Sciences Greenhouse of Central Pennsylvania based in Harrisburg. Our organization is one of 3 greenhouses in Pennsylvania with a mission of supporting the commercialization of promising life science technologies. Along with guidance and support, we provide seed stage venture capital, typically while companies are pre-revenue. Our investments start at $250,000 and can reach $7 million over many years. I currently serve on the board or as a board observer for 4 of our portfolio companies. I also serve as an adjunct instructor at SMEAL, teaching entrepreneurial finance for resident MBA students. In that role, I administer the Garber Fund, which provides investments of up to $100,000 per year in 2 companies as determined by the students in my class. I also would just like to echo Jonathan's thoughts about Kelly and her team. They do a remarkable job, and I'm grateful for this conference and everything it's done for the entrepreneurial ecosystem here in State College area.
Great. Thank you, everybody, for those introductions. So before we get into the panel discussion, just a quick note. During the presentation, if any of the members of the audience have a question that they would like to ask, you can use the Zoom Q&A function. My understanding is there's also a way to text questions in. We'll plan to leave a little bit of time at the end of our panel discussion to address as many questions as we can. So let's go ahead and get into the discussion. So first, I'll ask the initial question to Hunter and Shaunak, given sort of the 2 ends of the spectrum at which you sit from the perspective of our panel. So when the COVID-19 pandemic accelerated in April and May of 2020, what was that like for you and your organization, and how did you respond? And I'll go ahead and start with you, Hunter, if you don't mind.
Yes, I would say that just like the rest of the world, uncertainty. I think that for us coming into the year, I actually started the fundraising trail in January before COVID was really even in the news. We had set out with some pretty ambitious goals last year, and fortunate for us being earlier stage, a lot of our efforts in 2020 were focused in research, which was pretty unaffected. We got product out into some of our field trials. That planting usually happens in some of these field trial crops in the spring. And so we were able to get a lot of that push. As you can imagine, those sales is very difficult to do when we're all sitting here on Zoom, especially in our industry where relationships are pretty important. So we felt that we kind of put ourselves down in hunker down mode and was really in cash conservation. It actually ended up being a phenomenal year for us in the fact that COVID forced us all to stay home and spend way too much time internally. And I think being able to take a deep breath and look inside, step away from some of that fast-paced growth and be able to re-strategize going forward led to a lot of desirable outcomes. Like I mentioned, I hit the trail in January. We saw the venture space react the same way as everyone else, very much turning inward, looking at their own portfolios, using a lot of that dry powder to continue to support through who knows how long this was going to last at that time. And so fortunate for us, we went out for a $5 million raise. And we ended up closing $10.3 million at the end of the year oversubscribed. So it turned out to be a great year, but it was certainly a rocky one.
Great. How about your thoughts, Shaunak, please?
Yeah, it's a good question. It's hard to believe that a year has passed now. But last April and May obviously was a unique time, I think, in general, just in the early days of COVID, perhaps even more so from my perspective, being an investor that focuses exclusively on healthcare. I'd say probably two key things kind of happened for us during that time period. The first, as Hunter alluded to, absolutely spot on, is we had a significant focus really inward facing. And that was to really be a support system to our existing investments in our portfolio companies. Rewind 12 months, nobody really had any idea of what was in store, regarding COVID. And so we work very closely with our management teams to put into place plans really to prepare for a range of outcomes, because we didn't know the duration, we didn't know the severity of the impact of the pandemic. And so we were forecasting what the impact could be of COVID to the business's performance. We were forecasting what the business could look like from a recovery perspective, when that could potentially occur, what that recovery would look like. And then obviously front and center was cash conservation, looking to shore up the balance sheets, not only to make sure that companies could survive the pandemic, but at the same time, put them in a position of strength really to come out the other end in a position to succeed. So I would say that half of our mind share was really focused on internal efforts. The other interesting dynamic that occurred for us was that we were able to make some opportunistic investments as well. Despite the COVID headwinds, there were a lot of really great companies with very compelling technologies that still needed to raise capital, despite what was happening from a macro perspective. And while some of the other investors, I'd say, had ultimately decided to kind of hit pause given the macro uncertainty, we were able to find and really get conviction around a couple investments during that time period to back great companies and great management teams. And so I think for us, that was an opportunistic time period as well.
Great, thank you both. So let me move on to another question and get Steve and Catherine involved. So Steve and Catherine, and I'll start with you, Catherine, on a response, but do you consider the last year to be a success for your organization, and why or why not?
There are two answers to that, Jonathan. One, I'd say yes, it was a success. We had multiple exits. As it turned out, to our surprise, the corporations remained strong, and their balance sheets were loaded with cash. So we had 4 exits last year, so very profitable exits. So in that sense, it was very successful. We also found working with our companies a success. I think it was already alluded to that we helped our companies extend the runways, provided some additional cash, helped them work through expenditure decisions, applying for PPP money, EIDL loans, things like that. That was very beneficial for many of our portfolio companies. But the challenge for us, unlike Shaunak, we had a problem finding new investment opportunities. We rely so much on in-person events and walking the hallways of CMU and University of Pittsburgh, things like that, in order to get access to deal flow and start meeting companies and learning more and more about the teams. And we're a very process-driven organization. I mean, we work more like a VC than we do a traditional angel group, because we use a 4.5-page checklist of due diligence points. So I mean, for us, it takes us time to make that decision to write the check. And so that has been a challenge and continues to be a challenge for us, is to find new opportunities to add to our portfolio. So that's why I say yes, somewhat, but no, we're missing out. We want to see some new companies and want to add them to our portfolio.
How about from your perspective, Steve?
Sure. Yes, I do consider last year to be a success for Life Sciences Greenhouse. All but one of our portfolio companies were able to weather the pandemic very effectively. Most of our companies utilized the Paycheck Protection Program, which really provided critical support so they could maintain staffing when their business activity was highly disrupted. The companies that were most impacted in our portfolio by the pandemic were mature revenue-generating businesses. Fortunately, these companies had some combination of either strong cash reserves or existing investors able and willing to continue to invest. We certainly participated in several of those. The one portfolio company that did fail was really unable to attract other investors, which may have been exacerbated by the pandemic and just maybe the lack of comfort of investors to invest in something at such an early stage.
So I'll go ahead and move on to another question. I'll ask this one to you, Hunter, being that you're here from sort of the founder's perspective. And you talked a little bit about how the last year was helpful in getting ready for your capital raise. But I guess getting into the capital raise itself and the fact that you noted that it was so oversubscribed, do you feel that the process that you went through was helped or hurt by the pandemic? And, was there anything because of the pandemic that was different than what you expected or how you thought things would play out?
Yeah, so I think at the beginning of the year, obviously, like I mentioned, COVID wasn't really a thing when I started the fundraising trail. And I had a lot of really, warm conversations, felt like they were moving forward. And I think the challenge as a founder in any fundraising, process is just accurately reading those conversations. I think what happened to me personally was the second the pandemic hit, those warm conversations fell off. A lot of the events and conferences that I typically would attend earlier in the year to go meet with a lot of these folks, either new funds or continued conversations and face-to-face, all disappeared. I felt like a lot of folks, as they turned internal and supporting portfolio companies, deal flow started to diminish. And then I think in terms of where we were, that earlier stage capital, I feel like, a lot of folks, I guess, maybe turned towards less risky deals in some sense. Then at the same time, I think some of the positives as we started to work through the pandemic and starting to realize that we're all going to be sitting on Zoom, I actually felt a massive uptick in conversations that could occur because now all of a sudden we all had this free schedule. There was no more traveling, and all of a sudden people were, VCs were more likely to jump on the phone with you via Zoom and hear what you have to say. We got strung out for a while through a couple different conversations, and then we kind of had this sideline conversation come in that just completely took lead on the round and got us across the finish line in about 60 days. So all in all, the year was a success, but it was certainly a nail biter coming up onto the deadline here of running out of cash. And we were fortunate enough to be able to take advantage of the PPP loans as well, which gave us a few extra months of runway, which was pretty significant during such a critical year.
So moving on to another question, and I'll ask this to all of the investors serving on the panel. But as you think about sort of the coming months and years, what changes do you expect your organization to make in how it operates and invest in the coming years based on what has happened in the pandemic? And Shaunak, I'll go ahead and start with you, please.
Yeah, it's a great question, Jonathan. I guess I'd answer in two parts. On one hand, I think much of what we do as investors will remain the same in the sense that we're still looking for companies that address an unmet need in a particular market, has a differentiated offering, a clear value proposition, and led by a world-class management team. I think that mandate is going to stay intact. However, other things certainly will change. I think Hunter and Catherine already alluded to this a little bit, but from a tactical perspective, using virtual tools to meet and evaluate new investments, I certainly believe will become permanent in some shape or form. Don't know exactly how that permanence will look like, but we as EW are very much a relationship-focused firm. So Zoom calls ultimately will never replace that interaction and trust that you build with the management team in person. But with that said, it certainly offers a lot more of an efficient way to interact up until a certain point. So I do think just tactically how we go about doing our business will evolve. The other part I would say in terms of how we think about investing is it's hard to sit here and say that you can prepare for every risk and every unknown. If I were to rewind a year ago, that just isn't practical. But I think what we can prioritize as investors is seeking out companies that have the flexibility to stay nimble and kind of adjust in real time. That certainly has been a key to success over the past year for many companies. We've seen it in our own portfolio as well. And what I mean by that, just to give an example, is being able to flex as a company, for example, during Q2 of last year, when nearly everything in the economy, particularly within healthcare, was shut down. But then very quickly in Q4, when things started opening back up, being able to ramp back up as a business and as a commercial entity was critical. And if you can ramp back up quicker than your competitors, for example, then perhaps even an opportunity to gain share in your market. And so that's all to say that while you can't predict an event like COVID, you can certainly invest in companies that offer a certain level of flexibility during uncertain times to not only stay afloat, but then also stay successful coming out the back end.
Sorry about that. Thanks, Shaunak. So Steve, how about you? Thoughts on how you'll approach investing differently as we move forward?
Yeah, it's again a good question, Jonathan. I really don't see big changes in how we operate. We tend to invest for very long horizons. So and it was obviously challenging whenever we're trying to meet with companies via Zoom. It's as mentioned, it's really so much better to meet in person. And I think the other thing we like to do is really visit facilities for companies we're investing in. We get much better insight into the company if we can go visit the facilities and meet the entire team as part of a due diligence process. So looking forward to that basically opening up again. But in the grand scheme of things, I can't say us really changing our investment thesis in any significant way. And look forward to overall investment activity picking up in general in the overall industry, which should help our portfolio as well as others too.
Great. And how about from your perspective, Catherine, anything you'd like to share and sort of how you think about investing going forward?
Yeah, nothing to add. I mean, both Steve and Sean hit the the nail on the head for for how we view it as well. So nothing new to add to that.
Let's move on to another question. So this one I'll ask of Catherine and Steve, just given sort of the size of the investments and the stage that you're interested in. So what suggestions do you have for companies that are interested in pursuing an investment from your organization going forward? And Steve, maybe I'll start with you on that one, please.
Sure. Yeah. So for the LSGPA, we really encourage prospective companies to fill out a simple application on our website, lsgba.com. It just takes a few minutes just so we can capture contact information and get some general idea of what the company is all about. The companies that we can really consider have to have a significant presence in Pennsylvania, and also pursuing a technology that has adoption potential in the life sciences. It doesn't have to be 100% life science company, but if it has a strong application that has significant life science potential, we would definitely consider it. We primarily look at 4 criteria when evaluating companies, no different probably than Catherine or Shaunak's or other investors. We look at technology, the market, management, and the finance, and those are the really 4 criteria that we really drill down on in terms of due diligence. And also, when companies come to us for investment, we really encourage them to have previously engaged with Ben Franklin Technology Partners as soon as they possibly can. We find they're just an excellent resource for support and initial funding that can really help get a company established and starting down a good path. And we also really encourage companies in the life science space, particularly, to really try to utilize SBIR and STTR funding. The more they can get non-dilutive funding from these kind of entities, it really just can make a huge difference and reduces the need for capital from our organization as well as others. So I really encourage that as much as possible.
Thank you, Steve. How about from your perspective, Catherine, please?
So I'm going to treat this as an opportunity to educate our audience on what is angel capital, right? So angels basically invest anywhere from 27 to about $50 billion a year in the United States. 27 of that, as I said, 27 billion is pretty well tracked. The rest of it comes from some, like I say, indications of those loosely organized organizations and crowdfunding sites and things like that. So, but one of the things I think it's really important for our audience to understand is that the angel market is probably the most convoluted market, because there's everything from friends and family that act like angels and also unsophisticated, and those who are sophisticated, and those who like to do their own thing and be super angels, invest $1 million to 50 million of their own money, right, in any one time, so bordering into family offices. And then there are those who aggregate their money and their knowledge and act more like a micro VC. So there's more variations in that, but I'm kind of bucketing them. I think that's really important for our audience to understand that just because someone says I'm an angel investor, they have angel in their name, it's not the same. And they really should do their research and try to understand, is this the kind of partner I want? Like for instance, we're more like a micro VC, and we syndicate with other angel networks, and we use the National Venture Capital Association, term sheets and documents and things like that. So we're not going to invest in safe notes. We're not going to, we'll do occasionally a convertible note, our preference will be preferred stock, and at a point when a company needs 1 to 3 million. So my point here is that for the audience is just, make sure you learn a little bit about who you're going to talk to before you go talk to them, and understand, are they the type to like to get into the early point, and it's a point where, they're going to invest in a safe or convertible note, or are they the type that is a professionally managed group and they're going to syndicate with others and they're going to bring other money to the table with them besides their own money, that kind of thing. So just know who you're talking to. So.
All right, so I'll ask in the next question just for general predictions, and quite frankly, I'd love to hear from each of the panelists. Coming out of COVID and thinking about the landscape of venture and growth investing over the next years, what would you predict happening? And I ask that sort of in broad sense, right? From sort of how people will return to work, new entrants potentially from the investor standpoint, different types of deals, the availability of capital, valuations, opportunities, et cetera. So I'd love to have any thoughts you have about sort of what it will look like going forward and what might be some surprises or changes from what it was before. How about you, Shaunak, please?
Yeah, it's a fair question, Jonathan. I would say generally I'm optimistic for the next year in terms of how the investing landscape will unfold. I think maybe to break down your question into a couple different parts, operationally, as for investing firms, I fully expect a lot of the venture and growth institutional investors to go back to the office probably in the back half of this year is probably my best guess, largely aligned with when vaccinations become more widespread. And that I suppose is not unique to investors, but more perhaps just generally kind of corporate America. With that said, I think the nature of our business is that it's been pretty seamless, candidly, to transition to work from home. So I don't see the transition back to the office environment really having a huge impact, other than being able to meet in person with new investment opportunities. And like I shared before, for relationship-focused firms like ourselves, that's obviously a key point in terms of sourcing new investments and evaluating new companies. So I do think that point will be a positive change. Secondly, I think there's a lot of capital out there. Fundraising has remained fairly sustainable and has continued to grow during the pandemic period. A lot of new capital has continued to come into the alternative asset class in general, and specifically venture and growth investing. So I certainly hope that continues to remain strong. I think that's a good benchmark for companies that are in the venture and growth stage looking to raise capital as well, because there's a lot of availability out there for funds to support their growth. I think the key question in my mind is what happens with valuations. I think you probably have to look at it on a sector by sector basis, but it's not uncommon for a lot of different areas out there right now to be trading, at least in the public markets, to be trading at near all-time highs. And so whether that's sustainable and for what duration, I think is the real question before there's some inevitable reversion to the mean. But obviously that's tough to look into the crystal ball. I think, the one thing that I would end with is just, I do expect companies in general to return to kind of a more offensive mindset. And what I mean by offensive is whether it's returning to investing in their kind of commercial growth, or larger companies or strategics returning to becoming more acquisitive again from a business development perspective or M&A perspective. I think a lot of that was ultimately put on hold for the obvious reasons last year, but I expect companies to return to that offensive mindset as the macro situation further stabilizes over the course of 2021. But overall, I would say I'm optimistic.
Jonathan, can I take the next thing? Because I'm going to take an opposing view. So I think what I see here, particularly for us in this, when I say us, I mean Penn State across to Pittsburgh, across the Midwest, is I think it's going to, I continue to see a trend that's problematic. There has been this barbell issue. First of all, 76% of the capital, the big capital, is on the coast. So think about that. So the rest of the capital is spread across the middle United States, which we fall into. And so we are the, if you think Penn State across to Pittsburgh, we're in that sector where it's a lot more challenging to find venture capital. That's number one. Number two, this barbelling effect is in play, and it continues to grow. Venture funds continue to get bigger and bigger. So multiple millions and billions under management. And then there's the micro VC that continues to grow. So it's really easy to, hey, I'm going to do a crowdfunding site and raise all this small amount of capital. And then I see more and more people saying, oh, our accelerator is going to start a seed fund. And what I saw happen in Pittsburgh, I mean, there's now I don't know how many seed funds available, which years ago there was hardly any. But there is no Series A and very little Series B funders that are in our region and focus. And Hunter, I think, can probably speak to this more specifically, how difficult it is for companies that are doing well, that have to go out and compete with the venture, the coastal VCs who are looking at things in their neighborhood that they know and they become familiar with. And, they know that founder and the founding team, they've been watching him for some time. And there's this outsider coming in from Penn State or Pittsburgh or Erie or Cleveland or whatever, and they're trying to raise money. It's a lot more challenging. And I have this is my soapbox, as you can hear, is we need Series A funders and Series B funders to put up a shingle or consider raising our own funds locally. We need local people to support that. We need foundations to support that, institutions to support that, so that companies like Hunter's, can really have an opportunity to, not have to spend 2 years, raising money and trying to get the attention of the outside coastal VCs. That's just my soapbox. And I don't see it changing. It's getting worse.
Yeah, thank you, Catherine. And I think that's interesting, right? And it's kind of to Shaunak's point about there being a lot of capital that's available. And I think all of us sort of feel that, but it's not necessarily pointed at the right places or at the right type or stage of a particular startup company. So that's interesting. Do you feel, as Shaunak said, sort of the same way about valuations at this point, that they're getting higher and higher? And is that sort of driven by there being a little bit of a glut of available money at the earlier stage of investment?
Yeah, we do see it at the earlier stage. And actually, we've turned things down because the valuations have been, we think, out of place for the stage of the company. And always our concern is, okay, if they do get the next round, will it end up being a down round? Because they're going to have to prove that valuation, right? Work up to that valuation, and then to prove that the valuation of which they just accepted, now we're going on, they have to go beyond that and grow, right, to get the next round. And I think it's problematic. I really do.
So Hunter, maybe I can come to you next. So predictions from your standpoint, it'd be great to hear from sort of the founder's perspective, and maybe anything that you've sort of talked about with fellow founders of companies. Would love to hear that perspective about what you think for the coming months and what it will look like.
Yes, so I think I can speak specifically to Catherine's point about being in Central PA, and I think maybe speak industry specific, being in the ag tech space, because I do think they're a little bit of two different worlds right now for me. So from an industry specific standpoint, I mean, I do think VCs are still pretty bullish in ag tech. It's a pretty long life cycle in holding time. I think that 5 to 7 year window, COVID did not have any impact on veering people away from their investment thesis. I think that what I've seen from a macro perspective is that folks are more challenging, more critical of business models, industry sectors, things like that. And I think the pandemic really shook some of these up, and I think also created opportunities for others. Ag tech is that one that I think everybody feels, if you hadn't, through food chain, supply chain issues that the pandemic brought up, if there's one thing that was deemed pretty essential, it's our food chain. In terms of being in Central PA, I do think, Catherine, you have a point. I think the challenge is that deal flow. So you're mentioning deal flow as a challenge as an earlier stage capital source. I don't think there's any shortage of capital to deploy. I don't think there's any shortage of activity. I think maybe in this little vacuum, we're not having these, more growth stage investments, Series A, Series B. But I also don't know if we have the deal flow to really merit a large group of funds in the area either. And I think that's something where we're starting to see, especially with the ecosystem at Penn State, really spinning out a bunch of exciting companies. But it is a void, and I think there's a reason for it. We're hoping that obviously, raising a Series A around here, that we can continue to grow and keep ourselves located in Pennsylvania.
Thank you, Hunter. And Steve, how about you? Predictions for sort of the way things will look coming out of this, and anything you're seeing from your perspective that would you'd like to share?
Sure. So I'd say if you look at life sciences overall, our organization really believes that 2021 could be a very strong year for both startups as well as venture investing. Obviously, the industry has been highly focused on the COVID-19, but there are still major health issues that should see a return of resources and focus as a pandemic subsides. It's definitely affected several of our portfolio companies, and looking forward to the industry, I'll say, re-engaging as far as technology adoption. But it's yet to be proven out, but we're very hopeful. Also say, and it really kind of gets to, I think, Catherine's world a lot, and our organization really is only successful if our companies can also attract angel investments. And we've seen angel investment really fluctuate a lot over, as depending on the economy, and I'd say predominantly by the stock market. Whenever the stock market's booming, we usually feel pretty comfortable about getting our companies to also raise money from angels. But when the stock market takes a 20-30% drop, most angel investors really just close up their wallets. But I really appreciate Catherine's point about our specific region. I think of our portfolio and the companies that basically had to close up shop. It was all because of the fact that they could not raise that next round of money, beyond what we could provide. And I think the more we could hopefully encourage somebody to start even a fund. I know, Pittsburgh's had some decent sized funds in prior years, but they've just never really, taken hold in any kind of long-term way. And hopefully things like 1855 Capital and others could help really kind of foster a future of, significant venture investment in the area. But, time will certainly tell.
Yeah, I mean, we've gone out of town quite a bit with our companies, and we've certainly have been able to syndicate. I mean, the angel groups, professionally managed angel groups, have really become the Series A investors. So, when a company needs 1 to 3 million, I'm syndicating with 5 of my colleagues, and I think our returns on investment, as a matter of fact, our 10-year return, IRR, realized IRR for the past 10 years, is 18.8%. That's a pretty good return, but it's only because we've actively worked it. It's not because we have, and I think about deal flow. I mean, quite honestly, if we didn't have good deal flow, I don't think we'd have an 18.8% IRR right now. So, I mean, to your point, Hunter, is there deal flow? I think there probably, I think there is. And it's been managed through syndication with other investors. A proactive stance that we as investors take in our companies to make sure they get the funding they need, which is unfortunate a lot of times because, as you said, Steve, once we get hit by negative, particularly with, negative performance in the stock market, that does impact it. And then if I have to now take money from, put more capital together for a Series A round, Hunter comes to me and I really want to invest in Hunter's company, which is the truth, by the way, because we've been in touch with Hunter. We were telling him that, but it was like, we're in this, we're spending all this time protecting our portfolio companies and syndicating these rounds. And, and now, I can't expand my portfolio as much as I would like. So, I mean, I can go on, but just making my point, I guess. So I'll stop.
I'd love to add to that too, Jonathan. So, I think another key point in trying to fill in this vacuum or this void in the Midwest, Central PA area is industry specific. So, a lot of times when you get to that Series A investment, I can speak on my behalf here, it becomes very industry specific. The general VCs, they start to, lose touch, I guess, at that point, if you're not some hot, trendy tech, industry. I think that's a challenge as well, is that what is the area trying to be? what industry do we want to service? And I think we kind of kick around a few ideas, at least in the Penn State ecosystem. Are we going to be material science? Are we going to be agriculture? And so I think that's a key void. I would also maybe take the 60 seconds here to give feedback to the community here that's on the phone and tuning in today. And I think from the angel and the earlier stage VC funds in the area, it's early stage capital. And I felt one of my challenging points earlier on in our life cycle as a company was attracting that capital, willing to take that risk, especially in an industry that nobody really understood. And it was challenging. I spent a lot of time going through the ringer at all of the angel groups and VC funds in all of Pennsylvania, from Philly to Pittsburgh and around. And you get a lot of great feedback and not a lot of decisions. And so I think that early stage capital, it plays a very, very critical role in beefing up that deal flow and attracting the bigger stage funds to the area. So make investments is what I'm saying.
So we have about 10 minutes left now. So I would remind our audience, if anybody would like to ask any questions, please do that using the question function. But I'll ask a final question to our panel. And so I would ask everybody on the panel to think of themselves as sort of industry agnostic at this point. I know some of you are in focused funds. But what do you see as sort of the hot areas coming out of the pandemic? What industries, maybe if it's even through word of mouth, do you think will really sort of accelerate faster than other industries, and what do you think will be sort of the outcome for particular industries? So maybe I can go back to you, Shaunak, and start with you, and then have the other panelists kind of share their thoughts as well, please.
Yeah, absolutely. I'll try to keep this, I guess, more general, but I would say a big theme, won't be any surprise to anybody, is really virtual tools. I think that's, we've talked about it a little bit, but I do think remote tools, productivity tools, or access tools will have a permanent space going forward. I think that'll be a hot area for investment. I live and breathe the healthcare space, so I'll just talk about at a high level an application there. But virtual tools, what we would refer to as telemedicine, is an incredibly hot area in healthcare. It's not a new area. Telemedicine has been around for a while. It's been a buzzy area that's candidly made a lot of sense, but has just been slow to gain adoption historically. Obviously, along came COVID in 2020, and all of that changed almost overnight. And so from an application perspective, you have last year, a lot of provider settings, whether it be hospitals or your local dermatologists, that those practice settings were effectively shut down. But patients obviously still need care. And on the other hand, you had these really elegant software tools, video tools, virtual tools that allow doctors to still give really high quality care without needing to see the patient in person. And there's limitations to it. It doesn't apply to all things, obviously. There's certain therapeutic areas that lend itself better to virtual care than others. But the point being is that I think COVID was an opportunity for telemedicine to really shine and to prove that it was a sustainable provider mechanism to care for patients, see patients. And because of that, it's a tremendously hot area in terms of investment. So I would say virtual tools overarching, and then within healthcare, telemedicine is an area I would keep an eye on.
Thanks. We did get a question that I'll go ahead and pose to the panel, just came in. And I think it goes to the point that you were making, Catherine, and Hunter and Steve as well. So the question is this: I'd love to have your thoughts on it in response. So given companies moving out of major coastal cities inland, will they not pull more VC with them? So thoughts about that, and potential for that maybe being sort of a change going forward if people are pulling out of major coastal hubs. Have you seen anything along those lines, and do you have any thoughts about it generally?
Yeah, it's funny. I wish I could think of the gentleman's name. He's a VC out of California, and he just loves Montana. And he just pulled up ship and just went to Montana and launched a fund in Montana. Now, you think there's not deal flow here. Let me tell you what it's like to try to find deal flow in Montana. So I think there will be some of that, obviously, again, because of what Shaunak was saying about was, there was virtual tools, things like that were going to facilitate those kinds of things. So can it happen? Sure. I mean, everyone wants to have their second or third home. Again, keep in mind, these are the VCs that have multi-millions and billions under management that are doing this. And so, when you're building a company and you're going, you have to attract venture capital at various stages of your growth. It's how do you get from point A to point B? So I guess I'd say, yes, that's possible. Do I see it happening in big waves? Probably not. I will say this, we watch Chicago very closely. We co-invest with colleagues in Chicago quite a bit. The return on multiple capital invested in 2018 and 19, and I don't know the 20 numbers yet, the multiples have exceeded what has happened on the coast. I think last year, and in 19, it was 5.21x, or before that, a 5.18x. And if you compare that to the coast where they have multiple billions under management, it's 4.12 and 4.23x. So, I think that we'll start to pay attention to this and say, wait a minute, these underserved markets, maybe we should be looking at these. Look at these multiple returns on capital that are being generated in Chicago and in Pittsburgh, by the way. To answer that question, I believe, yes, that will happen with some. Drive Capital went to Columbus. That's another one. Drive Capital founders in Sequoia. One of the founders grew up in Columbus and said, I want to live in Columbus. I want my family in Columbus. And he, I think now they have 1.2 billion under management in Columbus, Ohio. So, that is happening. I just don't see it in a major way.
How about any other thoughts on that, Steve or Hunter, from your perspective of being in sort of the State College area?
Yeah, I would say I've been reading very conflicting things. So I'm actually down here in Tampa, Florida, and there's a mass exodus coming out of New York City, and everyone's relocating down here in Miami. And I think Peter Thiel just relocated to Miami with his fund and stuff. I think you're seeing it at the same time. I just read an article this morning on TechCrunch that's saying that Silicon Valley, you have the highest density of billionaires in the country sitting in 100 square mile radius. The capital's not going anywhere. And a lot of the folks are still staying there. A lot of the activity last year was still in Silicon Valley. It's just not in the traditional sectors. So, I don't know. I think it's challenging to say, and I think it's probably too early to say, but you certainly are seeing some high profile funds or names leave your traditional 5 cities.
How about you, Steve? Any thoughts and experience from your perspective on that?
Yeah, I really can't say I can add much to that. I think it's a good discussion, but the only thing I would just say is that I think it should challenge all of us to try to figure out how we can get people to want to relocate to either Pittsburgh or the State College area to set up a fund. So if there's anybody in a network that can make that kind of thing happen, it'd be wonderful.
Give me a couple years, Steve.
Okay.
All right, so it looks like you have one more time for a question, or a little bit more time for a question. This one's actually directed to you, Catherine. I know you talked about this a little bit before, but we have a specific crowdsourcing platform reference here. So the question is, how have crowdsourcing platforms like WeFunder changed angel investing? And you talked on that a little bit, maybe any experience with WeFunder, or kind of how you've seen those types of platforms really change what would have been traditional angel investing.
This is why it's really important to know your funders. Okay, so there's 2 different ways that you can raise money in crowdfunding. You can do it with accredited or unaccredited. For accredited investors, that means angel investors. So it has, I think it's brought some efficiencies to the marketplace. So you'll see a lot of things that are happening, like groups are forming in AngelList, for example, or WeFunder or Republic. Some of those. The problem it creates for companies, and this is the thing that I think all funders should be aware of, is whether when you raise money under Reg D, whether you're checking 506 or 503B or 503B, right? Or what is it, Jonathan? B or
506B.
506B. Yeah, I always want to say 506B or 506C. And if you raise it under C, you're going to have a hard time finding venture funds to want to come in and invest after, following, under that regulatory check mark. There are some things, and Jonathan, you probably know this better than I do. There are some action items that shareholders can take that can really make it messy for follow-on funders. So, and if you're going to go the crowdfunding route and you need follow-on venture capital, then you should do the 506B. Make sure it's that kind of offering, and you stick to all the rules and regs under 506B.
Thank you so much. So we're at the end of our time, everybody. I'd like to say thank you again to our panelists. I think and I hope that for our audience, this was really a great opportunity to take stock of where we've been and where we're going. I appreciate everybody taking the time. We would like to again thank our sponsors for all of their assistance and support of the PSVIP conference. Thank you everybody for attending today's session. And I would note that our next event is the Penn State Tech Tournament, which will be held at 2:45 p.m. We hope that you'll join us, and everybody have a great afternoon. Thank you.